You know, when a country's currency goes into a nosedive, most of us just see, well, chaos, right? But what if you saw something else? One person did. And they ran three absolutely fascinating real-world experiments to see if you could actually pull a profit out of that chaos. So, that's the big question we're tackling here. Is it actually possible to profit from economic chaos? Or is that just a surefire way to get, completely burned when a financial system is pushed to its absolute limit? Okay, so let's set the scene. We're in Turkey, late 2021. The Turkish Lira is just all over the place, swinging wildly from day to day. And right in the middle of this financial storm, one person decides, you know what, I'm going to run a few experiments. Three very different tests to get an answer. Now, the first experiment hinges on this core idea in finance called arbitrage. And don't worry, it's simpler than it sounds. Really, all it is spotting a temporary price difference. You buy something in one market, you sell it for more in another, almost instantly. Think of it like finding a temporary glitch in the market's code. So let's dive into case number one, the iPhone arbitrage. The person who ran this called it a preemptive strike against inflation, which is just the perfect way to describe what they were about to do. The game plan here was beautifully simple. Step one, go out and buy a brand new iPhone, paying in Turkish lira. Step two, just wait. The whole bet was that a company like Apple would have to raise its local prices to make up for the collapsing currency. It's not a matter of if, but when. And step three, the moment they do, sell that iPhone for the new, higher price and boom, profit. And that's exactly what they did. They pulled the trigger. The initial investment for this shiny new iPhone was 18,000 Turkish lira. All they had to do now was sit back and wait for Apple to make its move. And it paid off. Like clockwork. Just as they predicted, Apple hiked its prices and the phone was sold fast for 22,300 lira. That's a clean, simple profit from a textbook arbitrage play. They basically just anticipated a totally predictable corporate reaction to all the currency chaos.
Okay, so case number two, which is called the VR timing game, is where things get a little messier. This is where we see a wild new factor come into play that can completely steamroll a good strategy. Pure dumb luck.
So this time, the item was a used Oculus Quest headset. The goal was pretty modest, actually. All they wanted to do was sell it for enough lira to get back the original $300 it cost. And as the lira kept dropping, they just kept inching the asking price up. Simple enough, right? Well, then things took a very, very unexpected turn. And this is where the timing is just insane. Get this. On December 19th, they sell the headset for 5,500 lira. The very next day, the lira absolutely craters, hitting its worst point ever. But then, just a few days after that, the government steps in with these dramatic emergency measures, and the lira skyrockets back up. So check out what that wild swing did to the value of the sale. When they sold it, that 5,500 lira was worth about $333. Goal achieved. A small win. But then, just days later, because the lira recovered so hard, that exact same 5,500 lira was suddenly worth more than $530. A modest little win accidentally turned into a huge one, and it was all because of the ridiculous timing of the sale. The experimenter's own words sum it up perfectly with this question. Right place, right time, or just lucky? It's just a great reminder that when things get this volatile, sometimes luck is the biggest player at the table. All right, on to our final case. In this one, the refund glitch is where things get really, really weird. We're not talking about local markets anymore. This is about finding a strange loophole deep inside the plumbing of the global financial system itself. Here's the setup. It's a bit of a mind bender. Buy an item from Amazon Turkey, but pay for it with a credit card based in US dollars. Then, you wait for the exchange rate to change. And after it does, you return the item for a full refund. And just see what the heck happens when that money travels back across the currency divide. And the numbers? They're just nuts. The initial purchase was for 14,213 lira. At that moment, it translated to a charge of about $910 on the US credit card. But here's the kicker. When they returned the item, Amazon refunded the exact same amount in lira. But Because the lira had gotten stronger in the meantime, when that refund hit the US card, it converted back into over $1,200. The result? A profit of around 35%. Just let that sink in. This wasn't a profit from selling a product, it wasn't from a clever trade, it was money that was literally generated out of thin air by a glitch in the international refund process.
And this left the experimenter with the absolute perfect question. Still not sure who ate the loss? Amazon? Capital One? The FX gods? It's this fantastic, unresolved mystery that just perfectly captures how bizarre and complex the back end of our global financial system can be.
Okay, so we've been through 3 totally different experiments. What does it all mean? What are the big lessons we can pull from these adventures on the edge of a currency crisis? Well, a few key things really stand out. First, we saw that simple arbitrage, like the iPhone case, can actually work as a hedge against predictable price changes. But then, with the VR headset, we saw how extreme volatility basically makes luck a massive, uncontrollable variable. And maybe most surprisingly, we saw that the guts of our global digital finance system have these strange, exploitable cracks, like that Amazon refund glitch. These experiments are an incredible window into how money behaves under extreme stress. But, and this is a big but, let's be super clear. This is not investment advice. These are fascinating stories, but they're almost certainly not repeatable strategies. And all of this really leaves us with one final big question to chew on. As money gets more and more digital, more global, more instant, are these kinds of loopholes just temporary bugs in the system that'll get patched up? Or are they becoming a permanent built-in feature of how money is going to work from now on?